Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, February 12, 2016. Looks like stocks were attempting to firm up this Friday. We'll look also at some of the gaps going back as far as 2010, and if they do get filled, this could mean much more pain ahead for the stock market. Bonds hit an all-time high this week, bonds of all sorts, but I think they might be ready for a pause of some sort. The US dollar may have reversed, or we'll see if it did or not. We'll touch upon a subject of gold and GDX and its possible breakouts. Oil had a pretty strong counter-trend bounce on Friday also. While natural gas did not really benefit from weakness in dollar and may be ready to retest multi-year lows. Okay, so this is S&P 500 ETF SPY. This is a daily time frame, and looks like this Friday we had a pretty strong gap up and then a continuation higher. These are 52-week lows here, just Thursday and a couple of weeks ago. And S&P 500 ETF SPY actually the data includes the dividends in the data. So together with dividends, it's adjusted for, these are only 52-week lows. The next several charts I'll show that the index itself without the dividends is actually hitting already multi-year lows. But nevertheless, let's look at S&P 500 ETF SPY and this bounce up that could continue. So the first resistance is pretty obvious right here in the 188, 189 area, and this is from this failed rally on Wednesday, and this is a big rejection candle here. So if we get rejected here and continue lower, we could continue below August lows, and this would put ETF together with dividends in the multi-year bearish, in the multi-year lows territory. But I marked it with kind of pale red color, and you can see that it's probably not a very strong resistance. I think the stronger resistance area is here in the 196, 197 area. We have several things happening here. So number one is this 50-day moving average that's coming in here. We had a support break right here and then continuation lower. We had an attempted rally here that was stopped in beginning of February and then continuation lower. So there's quite a bit of stuff that's happening in this area, and this usually would mean there is resistance. Further up ahead, of course, there's this big gap from the first trading day of the year. This gap will eventually need to get filled. Again, I don't know, or pretty much nobody really knows when this gap will get filled. Again, it could get filled, within the next few weeks, or it could get filled within the next few years. Nobody really knows. But further down below here, we see that we actually are hitting new moves, new lows for the move for the breadth indicators. So the advanced decline lines, advanced decline volume lines, both hit new lows for the move. So this is confirming that we're pushing lower in the stock market. As far as breadth momentum, I am yet to see it in a positive territory. It's still in negative territory. So all of this so far is telling me that this rebound, should it materialize, most likely would be a good opportunity to get short. So let's continue to some of the other charts of S&P 500. Okay, this is a longer term chart of S&P 500, the actual underlying index going back 11 months. Here you can see that we have already broken down below August lows and September lows, and are actually on several occasions. We're still trading below the August and October lows. So this Thursday we hit a 2-year low. So this is 1810 mark. So this is already quite bearish, and I can say that this, S&P 500 is hitting multi-year lows because of the more than 1 year. Further down below, we have the percentage of stocks above the 20-day, 50-day, and the 200-day exponential moving averages plotted. So, we're in a bearish territory. So, low readings of percentage of stock above the 200-day moving average is a norm. What I would be looking for is this percentage of stocks above the 20-day moving average to move into the more or less bullish territory, somewhere around 60, 70, and then a failure there. So that will be a nice trigger potentially to go short already. Actually, it did just happen right there. We moved around into the 60% territory, and then we had a failure. So that was a nice signal right there. Let me see what else on this. Also, bullish percent index for the S&P 500 is firmly in the bearish territory. It's right now at 29%. To be in a bullish territory, we need to see a break of, well, at least about 50%, but much better about 60%. This is certainly not the case right now. Let's look at some of the longer-term charts next. Okay, this is a weekly chart of S&P 500 going back 3 years, and this is just for to show that we have indeed come to the level of 2014, beginning of 2014, and we are hitting a 2-year low hit this week. So this is all showing that the picture is still quite bearish. Okay, this chart is a daily chart of S&P 500 ETF SPY, and on it I actually went back to 2010, and I looked for what's called an unfilled gap, and I'll explain what that is. But the important thing is, here's a quote from MasterChartsTrading.com from the chart school: "Market abhors a vacuum and all gaps will be filled." Now again, we don't know when, and we don't know, at what time they will be filled, but those gaps will be filled. So first of all, what's a gap? A gap is a break in trading. In other words, there were no transactions recorded at that time. So let me just zoom in to current picture. For example, here in 2015 we had a gap right there, a really big gap I just mentioned at the beginning of the year, and it's still unfilled. Eventually it will get filled, so in other words, we will have a rally and that gap will be filled, but for now it hasn't yet been filled. So if we go back to a few years back, we can see that there is unfilled gaps still that are in existence. For example, here in 2014, there was a gap up and continuation higher, and up to this date, there was no filling of this gap. Further back here in 2013, there were several gaps. Further back here in 2012, and here even in 2011. And then even further back in 2010, there were several gaps here as well. This gap, for example, right there, was filled by this drop, but these two have not. So what does it mean in real terms, and what does it even mean? If this gap from 2010 gets filled, this would mean that we are going to drop another 47% for S&P 500 ETF SPY. It's a pretty hefty drop, but in the context of a bigger trends, this may not be so out of the question. And actually, I'll show the next chart in a few minutes, and I'll show what I mean by that. Okay, this is S&P 500 going back to 1996, and on it I have marked the current bull and bear markets that are in current history. So we have here a bull market, a bear market, a bull market, a bear market, and another bull market that I think came to an end in September of last year in 2015. Here we have market breadth index, or MBI. This is the index that I created that is helpful in calling the bull and bear markets. So here in 2015 September, this index has called the bear market, and since then I was looking for only shorting opportunities. Here I drew in red, I have put in a Fibonacci retracement from the bottom of 2009 to the top in 2015. So a normal correction, a shallow correction for a security. Let's just pretend for a second that this is a 5-minute chart, and we had a breakout here, and now we have a correction back to the 38% retracement on Fibonacci retracement. That would take it to about what is it? About 1600, which is actually a breakout level above the previous two peaks. So that's a normal correction. And then of course the more deeper correction would be 50%, and a pretty deep pullback would be about 61%. Anything below 61%, and then this whole breakout would come into question, and we could potentially retest the lows here from 2009. Now, of course, I don't know exactly when this is going to happen, or if it's going to happen at all. Maybe Federal Reserve will come out and start printing money in earnest, and then we'll turn around and make new highs again. But from the previous charts that I just showed, we could easily fill the gaps going back to 2010. So that would put us back here in this territory and of about 1100 points. Not a prediction, of course, but it's something to keep in mind. Next, let's move on to bonds. Okay, this is TLT, iShares Barclay 20 Plus Treasury Bond Fund, long bonds. So we had a pretty nice run here for TLT and for bonds in general, from the lows of November to the highs basically on this Thursday, and this is an all-time high. And also TLT is a market leader, and when TLT is a market leader, that means that there is a general risk-off environment, and the investors are really not looking to return on their investment. They're really looking for return of their investment. And of course, TLT is pretty much the ultimate safe haven place for that. Now, here we have a 3 candlestick pattern, which could potentially be an evening star. Now, again, I wouldn't read too much into them, but if we do get a confirmation, for example, a move lower here, we could potentially correct to the breakout level here, or even maybe lower to the breakout level here. But in any case, this is an all-time high, so any kind of pullback would mean that this is going to be a buying opportunity in my book. Next, let's look at a bit of a longer chart of TLT. Okay, so this is a weekly chart of TLT going back a couple of years. So we hit an all-time high here at 135.25. So we exceeded the high from 2015. Now this candle is a bit of a could be a reversal candle, and we could see a correction back, but like I pointed out, this could be a cup and handle, and this breakout 8.2%, this depth of the pattern 8.2% could be duplicated on the upside, so we still have some potential to run higher. Or if this is the depth of a pattern, this is even a high, even deeper pattern, so we can see even more potential upside still. So that's just something to keep in mind as well. TLT is bullish, and I think any pullback is a buying opportunity. Next, let's look at even longer chart of bonds. So this is a Barclay Capital Bond Composite Index going back to 1999, and this kind of includes all of the bonds within the United States index of bonds. So I put in a 50 and the 200-day moving averages, and one of the ways to see if this is a bullish or a bearish security is to see when the 50-day goes below the 200, then this is a bearish period. Now it's pretty clear that this is a bullish security going back at least to 1998, and those bearish periods within the security were really very few and far, and even if the bearish period did occur, it was very brief. Now currently we're clearly on a up and a bullish pattern here, so we're at all-time highs, and this is most likely going to continue. Of course we could reverse it anytime, but my money is on the continuation of the pattern. All right, let's switch. Let's look at the US dollar, the currencies. So I keep saying that the dollar is bullish, and we're basically trading near 52-week highs, but so far have not been able to pierce through the 52-week highs. This could change at any time. Again, this could be a cup and handle. This is a cup, and maybe we're drawing up drawing out another handle for the cup, and then we'll break out the new highs. But I did actually point out this potential wedge. After this breakdown, we had a potential wedge or a rising channel. And then last week we had a breakdown here, and this week we continued lower. Now, if I was trading currencies, I would probably be buying at this point. This looks like a nice buying opportunity in my book. So if we do rally in the dollar, then commodities will most likely come under selling pressure, and of course the commodity that is pretty much in everybody's minds is gold. So let's look at gold next. Okay, this is gold daily spot price going back 6 months. So this cup and handle potentially, or definitely played out rather, and then it continued higher. Gold continued higher. Now from here, from the bottom of the this is actually a multi-year low, to this high just on Thursday, that's about 20% rise. Now it's a very steep rise, and this is a they call it a parabolic rise. Usually those parabolic rises don't end well. At the very least, there's going to be a profit. I think there's already profit taken here, and potentially we're going to see a pullback in gold. Now, of course, short term, if you're able to buy in this area and sell in this area, that's a very nice profit. To me, this is a bearish security, so I only look at bearish setups. So I still think that gold is bearish, and gold miners, I think they're long-term bearish. So I'm still looking for shorting opportunities. Now, what will it take for gold to become bullish? Well, at the very least, I want to see this 50-day moving average move above the 200-day moving average. That's a really good start. Next several charts, I show some of the other ones, and we'll go into longer-term ones, longer-term charts. Okay, this is gold spot price weekly chart. So each of the bars represent 1 week worth of activity. So here we have a low at 1045.40, and here we have a high from just this week. I put in Fibonacci retracements again, and if we do get a retracement, a logical retracement would be to around this area here that I drew in. Now, this is kind of like a normal retracement. I think this is still a bearish security because there's a multi-year low. So this breakout above these highs is still very much questionable. So if we do get a pullback, at the very least, I'm expecting it to pull back to this area. And if it goes back below this area, most likely we have failed this breakout completely. Okay, this chart shows GDX on a daily time frame. Here we had a bear trap. So when we had a break below the support and then a quick move back above it in the opposite direction. Several gaps here, and this is a gap above the 200-day moving average, and this is certainly a good sign for the bulls. This was actually also a very strong break. We had a gap and then a run above the 200-day moving average with several retests and then continuation higher. Now, so far, this is a strong breakout, and certainly looks, well, this is a very steep rate of advance. So a pullback of some sort is certainly in order. Will this pullback turn into a rout and then we make another low? That's a different question. Now let's look at some of the gold miners market breadth indicators, and I pointed out this bullish divergence here, but those divergences are hard to sometimes they don't come to fruition. For example, even though we had a bullish divergence, we made a lower low, and then afterwards we continued higher. But nevertheless, it certainly is a positive sign when we have advanced decline lines, advanced decline volume lines, and unbalanced volume, moving higher. And then bullish percent index also is now around 55%. So if you're a gold bull, this is certainly a welcome sign. Also, we're finally seeing some new highs in the index. So now we have some of the stocks within the index are making new highs. So these are all good signs. And obviously it's overbought because this is about 50% move from the bottom to the top. Okay, this chart shows a longer term picture of a GDX. This is a weekly chart, so each of those little bars is worth 1 week of activity. And we had several of the similar looking, so we have a pretty powerful looking breakout here. And again, I put a question mark there, so this could be a breakout because we had several similar breakouts in the past. The bear market in gold miners, I think, started around here in 2012, possibly even earlier. So this was a first potential breakout which failed, and then we had new lows. Then we had another potential breakout here in 2014, and I'm talking about breakouts when there was a close above the prior resistance. So there was a prior resistance here and a close above it. Here there was no close above prior resistance, here there was, and then here there was, and then here obviously there was too. So for now, it's one of the 5, potential maybe even more, maybe I missed some of the breakouts, but for now it's still a questionable breakout. We could turn around at any time and make another low. So next chart actually shows some of the market breadth indicators, the longer term ones that I look for to see if the security is bullish or bearish. Okay, so this is a gold spot price daily, but I removed the price and I only left the 50-day and the 200-day moving averages in place so that it makes the chart a little more clear. Now you can see that the moving average crossovers, they're okay for setting the trend, but sometimes they give this whipsaws, and they're quite annoying. That means that the trend was falsely changed, and then we assume that maybe this bear market has ended here in 2014, and of course it didn't because we continued lower. But here's a nice thing about gold and gold miners. We have a bullish percent index, and according to this bullish percent index, if we need to set a trigger somewhere, and I set it pretty low at about 20% for the bearish signal and about 80% for the bullish signal. So if we set it at this level, going back in 2012, we can say that the bear market in gold has started and gold has peaked around here. This up here is my experimental indicator. I'm still playing with it some more, but it calls pretty much similar thing to the bullish percent index. And still so far I have not seen either one of these indicators turned into a bullish camp. So far I have not seen a surge in bullish percent index or a surge in this my experimental indicator, or for that matter really even the 50-day moving average has not yet moved above the 200-day moving average. So gold really has a lot of work cut out for it, and until I see some improvement in quantifiable indicators and quantifiable data, I'm going to keep my bearish bias. So that's it for gold. Let's continue to other commodities now. Okay, this is West Texas Intermediate light crude oil on the daily time frame. So we had a pretty powerful rally this Friday. Oil was about 6.3% up for the day. This is pretty impressive rally, really. But we have to keep in mind that this is a rally of a multi-year low. So some sort of a bounce was expected. This initial bounce failed. I was actually kind of surprised that this bounce did not take it, higher, maybe to around this area, but it failed here in the $34 area. So now we have pretty clear resistance. We have, broken support in the $34 area. This failed rally, and also this 50-day moving average coming in here. So this is all coming in the $34, $35 area. If oil does rally in that area, then most likely the swing traders will come in and start, attempt to short it there. Long term, of course, oil is still bearish. Here's an interesting thing. This is Brent crude oil. This is a European benchmark versus the American one, which is a West Texas Intermediate. Also hit multi-year lows here together with the West Texas Intermediate and rebounded. But here, US benchmark actually hit new multi-year lows. But here, Brent held up much better than crude West Texas, and also is rallied here as well. So this is interesting divergence, and this is probably a bullish divergence, depending how you read it. But Brent is clearly stronger than West Texas Intermediate. Again, this is a bearish chart, so if you have an opportunity to short Brent, most likely, it will probably rebound around here to 38 and maybe higher to around 40, where this peak is coming in, 39.40, and then the shorts most likely will come in and attempt to push the prices lower. Okay, this is natural gas, spot price daily. So multi-year lows here, a rebound, failure at resistance, and then a continuation lower, and looks like a rising wedge. And then I pointed out this rising wedge break last week. Now here we had we had actually a gap up this week, but then immediately sold off. So I think this is like a failure at the 50-day moving average, because immediately afterwards we continued lower the entire week. If we break below these lows, especially below this $1.95, I think the door will be open to retest the multi-year lows from December. Of course, alternative scenario, we may continue higher and maybe retest this high here. But generally speaking, natural gas is bearish, so I'm only even looking for bearish setups. That's it for this week's recap. Please stay tuned how to find us on the internet. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just a psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. If you have Twitter, Facebook, YouTube, StockTwits accounts, you can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.